There's such a fine line, making money and losing money in the market.
We want to teach you the concepts.
You have to be okay with the type of trader that you are.
We want to teach you the processes.
This is what really gives the meat and potatoes to it.
We're going to teach you how to.
The bottom line is you want to make money trading.
I can promise you that I can make you a better trader.
Join T3 Live at the Boca Raton Hotel and Resort April 26th and 27th for an exclusive trading education event. Sign up now.
Markets are bouncing back a bit this morning, the day after the Dow saw its biggest down day of 2013. Also attempting a rebound are commodities, which saw the worst two-day slide of the past 30 years. Has the complexion changed? I'm Brittany Umar, and the morning call starts right now.
Good morning. My name is Scott Rudd, the Chief Strategic Officer of T3Live.com.
And I'm Brittany Umar, and together we bring you Morning Call. So futures are higher this morning after 2013's worst day of the year. Markets were under pressure during the session on Monday, and then the sell-off only intensified after news of the Boston Marathon attack. So, Scott, it was clearly an awful day all the way around.
Yeah, you had the weakness in the market, and then once the headlines started hitting about Boston, everyone all of a sudden shifted from the market and wanted to see what was going on there. You know, it's crazy when something like this happens, especially a function like the Boston Marathon, where individuals are training for a year, their friends, their family, their loved ones come to watch, and then all of a sudden chaos breaks loose. And unfortunately, it's still a sign of the times of this type of thing could happen, and I think we started to lose a little, sight of that. So our thoughts go out to the families and the friends of everyone that's been involved in that tragic situation. And now, as far as the markets are concerned, that really wasn't the blame of the down move. I feel like the move that started to the downside in the markets also started on Friday with the commodity sell-off. But when you get a situation like that, when there are unknowns about, how did it happen, why it happened, it just intensified the late yesterday move. So it'll be interesting to see, where we go from here, and we'll measure that type of bounce.
Right, yeah, and on a human note, we want to understand what happened yesterday, but on a markets note, what will market participants be looking for as we start to get more information about who did this and why, and if it could happen again?
Well, there are a few things. I think the next 2 days, first of all, unfortunately, you're going to probably hear some rumors. You're going to hear some talk of there's a package at the Waldorf Astoria. Is it a bomb? There's something at this train station, and you're going to probably have some volatility back and forth, and people aren't going to know what's real, what's not. So just be aware and listen up for the headlines, and also obviously make sure if it's just talk or if there's something behind it. Because even yesterday, I think I was one of the first few to tweet, explosion at Boston Marathon. Everyone wanted to make, figure out what it was. Was it a circuit breaker? Was it a manhole? It wound up being bombs. Okay, I think the next thing that individuals are going to be listening for is, who was responsible? Was it two individuals that grew up in the neighboring states that just don't like society and wanted to, make a name for themselves, which I do think is still unfortunate, and still it's so sad that it had to happen the way it happened. But I think the market would be a little less concerned about that. But if all of a sudden they have two people in custody that came in from overseas that have been planning this thing for 3 years, and it seems like they're part of a cell that could be all over the place, then I do think that could have wider ramifications across the board for the overall markets.
Well, it's hard to bring it back to the business side, but if we do talk about the broader market and we look at, say, the S&P, which was hit pretty impressively yesterday, obviously not as hard as the commodities, but would you say that being as futures are up this morning, that is just a pause in before we have more declines?
Well, I think the market's trying to stabilize. In the overall broader market, it was a big down day, played a little catch up to the commodities, but still on a macro sense, it's not broken. I would say we're a little bent, but not broken. And, IBD yesterday, which is something that I follow for big picture, has us back in rally under pressure, not market correction. And this is the third time we've had this since 2013, and it's led to nothing except for a quick few-day down move. So if you look here at the chart of the S&P, you will see that I've talked about 3 different pivot levels, okay, to start the year. First one was 1474. We broke above it and went all the way to 1530. This is when the Italian elections volatility hit. Then we just regrouped, went sideways, took it out, went all the way up to just say, this 1564. This was Cyprus right here. Then we took that out. This was that dismal jobs report. And then we took off right through, this prior pivot, squeezed a lot of shorts, maybe bait, we got some people to throw some money at the market that feel like they missed out, and then pow. So right now this is a little bit of a breakout failure. So a lot of people are trapped up here. A lot of guys who are rolling up their shorts probably feel a little upset that they might have gotten squeezed out, and some guys who chased it are like, oh, what do I do now? So the question is, what type of bounce do we have moving forward? And for me, we've talked about can the bears stay in control somewhat? If you remember right here, all they had to do is protect this 1564, and maybe we could have went lower and it blasted through. So now at this different stage, it's the same type of scenario. This was 1573, here's 1564. If the bears want to stay in control and we do get some kind of bounce, they don't want to let it go through this area because that would negate the potency of yesterday. Bears now are pointing out a bigger head and shoulders pattern, where that's your left shoulder, here's your head. Now the question is, do we put in a right shoulder and go sideways, and then all of a sudden you do have a pretty well-defined neckline that if we do want to correct, from just say this was as high as almost 1600 to 1640, that's 60 handles, that brings you down to 1480-ish, which will be a retest of that, and that I think in my opinion would be healthy, and that's when the 200-day would probably play catch-up. But this is all looking in the, not even the rear view mirror, it's looking into the future. As of right now, map out levels of places that would contain a bounce back, and right now that's like 1562 to 1574.
Well, every significant down day has been met with buying, so it'd be interesting to see if that trend continues. And one thing we can do is watch different sectors for clues about the market direction. And yesterday, starting with the transports, the IYT retraced almost 4%. So could we have picked up on this as a warning sign that the markets were going to head lower?
Well, if you think about oil going lower, that's cheaper fuel, and then transports would be more profitable. So people are like, oh, we should put our money in the transports with in the commodity decline, but they were that weak, so that showed you that the market was not really healthy. And if you look at the pattern of the transports, you will see that this already has somewhat of a head and shoulders pattern being built. Okay, this was your mini one up here that led to the first decline. This was your left shoulder, mini one, head, right shoulder, broke this neckline. This was that measured move down to support, held, bounced up lower, higher. Then look at the potency of this down move. So if we do try and bounce up and just say it gets contained by this area here and it makes another lower high and then starts to head back to support, next time it gets to the support, it probably doesn't hold, and then you see it move down to the 200-day. So this is definitely something to watch.
And over in home builders sentiment slipped for the third month in a row in April, declined to 42 from 44, while economists have been looking for 45. So most home builders were in the red, led by Meritage, Pulte, and Toll Brothers. The XHB took a hit as well.
Yep, and this has been a leading group, and this did not make highs when the S&P did, so there was a divergence there. Sometimes these divergences don't lead to a lot, sometimes they're just a pause, but this one headed back down. And if you look here at the XHB, you will see, look at the trend that's been in since last summer, and it's always been met with buying at this point, buying, buying, buying. Here are two accelerated trends. This one broke to the downside and was contained. This one broke to the downside and was contained. And it's only so many times that could happen until finally you get a little bit of something different. And if you look to where the actual home builders came from, they've had a very significant run. So to look where we are now and people are getting all worried, it would make sense that we could pull back a little bit. So if you want to measure the bounce in the XHB, if the bears want to stay in control, same sort of story here, right? This time it should not take out this 2890, 29 area. If you remember, last time you had this bounce back, we were like kind of take out this area. It pushed it a little bit above, but it still made a lower high. So I would say if this is, if you're looking at a shorter bounce and it gets turned down here, this is your short entry. And then if we break, this could give us clues. The broader market could see some more corrective activity, which after a first quarter move like we've had of 10+%, second quarter, why not try and pull back 3 to 5%? It's only healthy usually.
Well, and we have housing starts at 8:30 a.m. So if we get a big disappointment there, could that be what brings us lower?
Yes, especially since the data that we've been wanting to point to has been positive from housing. So we don't want to see negative, data start continually coming out.
Right. All right. Well, let's check on the financials. The XLF also slipped 2% yesterday after succumbing to weakness in the market. We had a strong report from Citigroup in the morning. We have Goldman Sachs out today. Could that possibly be what lifts the XLF because earnings expectations are highest for Goldman?
Yes. Well, there are two things. First of all, we've had two different earnings reports, or three, that were pretty solid. Yeah, JP Morgan and Wells Fargo last Friday. They were solid, but they weren't met with buying, so that could just show that they either need a pause or they've come too far too fast. Yesterday, Citigroup really tried to pull the banks higher, but the overall pressure was too much. If you look here at the XLF, you will see here's this actually made new highs with the market, so this is actually considered a stronger sector versus what I showed you with the transports, the housing, and even the Russell. And here's your move lower. It's still above this trend line. It's still okay. You look at Citigroup. Citigroup had good numbers, gapped up, closed on the lows. So this needs to be negated quickly. Otherwise, you could see more pressure there. It's a lower high. JP Morgan also, decent numbers. I'm not saying it's game over there, but I know I tried to be long and I got stopped out. I said, you know what? I'm going to play it for this intermediate range because if it breaks this, it could go back down to bigger support. So we'll see. I know Goldman was out this morning and it looked to be good. I walked in, before Brittany and I saw it was up. A little bit, like maybe 1% or so, up a few dollars. So I don't know where exactly it is where now, but if you're watching, if Goldman doesn't go up on what looked like to be good news, then I think that's going to add more pressure to the banks, which has been a stronger sector, which would also give some pointers that this market could retrace a little bit more.
All right, and over in retail had been leading the market up lately, but also shed nearly 1.7% following the sell-off. What are the levels to watch, say, in the RTH?
Well, RTH had its first pone down day, but it only gave back the 8-day. The S&P is already at the 21-day, and some of the weaker sectors are already through the 50-day. So you look here at the RTH, and you'll see first down day. Here's the 8-day. The question is, does it open up and then take this out and play some catch up? And then there's a 21-day. You have some really strong stocks in there, like Walmart, but Walmart looked like a small red dog reversal yesterday where it made a new high and closed in the lows. So see what happens there. It's extended from the 8 and 21-day. Lots of retails are extended right now. So it's something to watch also. It's been a stronger. So if you want to put like two different camps, you have the financials and you have retail that have been trying to act stronger lately. And then on the weaker side, you have the Russell, the transports, and the home builders.
And you have gold and
Yes.
other commodities, which
How can I forget?
was a big headline, spiraling lower yesterday. The GLD slipped another 8.8%, biggest one-day plunge in gold prices since 1980. So the big question is, how low can gold go?
Well, at this point, it went pretty low, and it's bouncing back like I think $30 this morning, but it's been crushed. Biggest two-day decline in 30 years. But I hate to say it, and I don't want to rub any salt in anyone's wounds. You could have really seen it, because we talked about the two different trends till we maybe, beat a horse over the head. And that's not a good thing to do, but it's just a saying. The intermediate trend broke at 161, and then on Friday, I talked about 148 to 149.5 in the GLD. I use the GLD. Everyone talks gold futures, but I know a lot of my traders intraday use the GLD, so that's why I use it. And you had some time to make adjustments. You could have, okay? Because I saw it there Friday morning. It opened to 148, bounced to 148.5, hovered there for a half an hour or so, and then broke. You look at the chart here of GLD, you will see. Here's the intermediate trend that broke. This nice little pennant. That broke around 161 to the downside. And what happened? First things first, it held macro support, because it usually happens, if you haven't seen it in a while, and it didn't see it all the way back from here. Then this time, it actually got there and broke through it, okay, and closed, through where I thought it would go. I thought it would go maybe 135 and went as low as 130.50. And now this overall move looks like at some point it should get to 123 to 127. But if you take a closer look here now, you will see that here is where you had your gap down. You had some time to make a decision, closing the lows. A lot of guys actually probably took this home short, right? First wide range bar through a macro support. So they came in yesterday with gold down and said, I'm a trader. I'm getting paid. I don't care about what direction. But anyway, here's your gap down, close near the lows. I would say if you look here, 136.75 is where this gap starts. So I think we're right around 134-ish, halfway through this wide range bar. So I think over time, perhaps it tries to get to here, maybe even push through, but I don't think you should be in a rush to buy gold. It has a lot to prove, and chances are, if I were a betting man, which I'm not, I trade probabilities. I think within the next few months, you will be able to see like 12.75 an ounce, which would take you down to like 123. In GLD, some people measure moves by the size of the channel. So if you look here, this is like what, 173. This is 148. That's 25 points from 148. So that, quick math takes you down to, the 120s. So we'll see if that's the case.
All right. Beating a horse over the head, beating a dead horse, either way, right? We got it.
You got it.
All right. Coming up, we're going to go in the trenches with some names ready to report this week. But first, a quick commercial break. We'll be right back.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our two very popular newsletter products, Off the Charts and the Price Point Sheet at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.
We're back and going in the trenches with names ready to report this week, starting with Goldman, which reported before the bell this morning. Looks pretty good, but not doing too much on the report.
No, and I think when I came into the morning call, it was up like 1.5%. Now it's only up like 0.5%. So almost the same way JP Morgan, Wells Fargo, and even Citigroup reacted to positive reports, because these banks have come a long way. So the question is, did they come too far, or do they have more room to go? And only the stock could tell you that. And right now, you look at the chart of Goldman Sachs, you will see it's had an unbelievable move from December, from 115 all the way up to the highs here of 155. Then it broke this trend. It became pretty choppy. And at this point, the question was, can it make new highs? Can the banks continue? Or do we need a rest? So as of right now, it's saying it needs a rest. And at this point, I think if you want to trade it, if it starts to go negative and it takes out 145.53, I think some people will look to be short this for a move back down to test the lows here of 140 and change. So here's your inside pattern. So if for some reason it does start to get better and starts to go above 150, 145 would be very healthy. But if it goes negative and starts taking out yesterday's low, you could see a move back down here, and then that will also affect the other banks.
And Yahoo reports first quarter earnings after the close. Investors' hopes are high as this stock approaches its best levels in 5 years. And it put in a new 52-week high, the $24.99 level, yesterday before pulling in to its 8 days. So it'll be interesting to see what it does on the report. Yeah,
this is very tricky because we talked about this as a 2013 pick of the year that I can get to 24 to 25-ish. And it got there. And it got there within, 4 months? Is that what, April, January, February, March, April, 4 months? So you always have to know, do you raise your expectations or do you ring the register? But no matter what, I think most of my traders do not take stocks into earnings, especially after such a big move. And if you look here from 1660, from where it broke out of this channel to the start of the year, right around 19 and change, and to hit the target of, this was almost 25, it's very tricky. Even if it has a great report, it might not go up. Look at, Barron's had a piece on it, how it can go up, more this year after this whole move this weekend, and opened up and reversed real hard. So I would say, each time I've tried to buy a dip, it's been at the 21 day. So if perhaps today it gets weaker and comes into this area, I'd rather see it come down a little bit more. If you wanted to take it into earnings, if it's too close to the highs, no matter what they say or do, it's going to be kind of baked in. So at this point, if you're planning to be in Yahoo for the next year, stay in it. If you were playing it for this move to start the year from 20 to 25, I would just avoid it. Maybe play it after earnings or do some kind of call spread. So at least you're involved if you want to be, and your risk is premium paid.
And looking ahead to Thursday, Intuitive Surgical reports on Thursday. This company has been looking really strong, has a lot going for it right now. And after a big sell-off in late February, early March, it's been able to reclaim its 8 and 21-day moving averages. So what are the key levels to watch as we head into earnings?
This one, some of my guys trade after hours because, again, it moves. When it moves, it could move like $40, $50, just like some of the other big boys like your Googles and your whatnot. So if you look here, to me, this chart's not telling me that much. What you do see is it's off the recent lows of 450. It's not near the highs here of 600. It's in the lower third of this area. It's actually below the 200-day. I do not know enough about this company to tell you what you should do into earnings, but I will say that above just say 516-ish, that's resistance, and then you have a move back to perhaps 550, and then these are your levels here. So if you want to do some kind of call spread and you're a believer in ISRG, maybe you buy the 500s and sell the 550s because that's probably where it could go. If you're a blockbuster, you think it's blockbuster, stock split, whatever, maybe you buy some here and then you sell the 580s. And then again, if you're on the flip side and you say, okay, look at the size of the move it's had over the course of the past decade, here's big support. Anything below 471, you could be in trouble. So, either trade it after hours or, do call and put spreads around the numbers, because there's probably a lot of premium in this one. So sometimes you could buy options and you're right in the direction, but it's not enough, so you lose your premium and you're like, wow, I was right. I went up 25 points and I made nothing.
Right.
So I would say do call spreads. It limits some of your potential, but at least it helps finance the play.
All right. Well, and Microsoft also reports on Thursday. The stock has continued to show weakness since its sell-off last Thursday on weak PC sales numbers. It dropped below its 200-day, and now I guess we just have to wait and see if earnings could be better than expected. Earnings could be a catalyst for the stock, or if we'll end up seeing it dragged lower again.
Yes, this is the type of thing where they don't have to be, blockbuster, just
Right.
not that bad. So if they're like in line, up a little bit, I think people wanted to buy Microsoft and some of these mega caps last week or the last 2 weeks, because it's like, okay, can't get any money in the bank. They have a yield, they have liquidity, it's a cheap stock price, and then all of a sudden Goldman said, the PC sector is weak, sell it. Who knows why? Maybe they were short going into the report. I don't know. But all I know is I'll be looking at this income earnings. Come take a look at the chart. If it were to get into this gap, which it might today because I think it was upgraded by Morgan Stanley, above 29.20, perhaps you do have, some type of move to fill some of this gap, okay, for a trade. If it waits till Thursday for earnings, that's okay. And if you want to take some kind of options in it, the stock really has gone nowhere in such a long time. And if you look at the monthly chart, I do think at some point, this Microsoft, just like people left Walmart for dead and they left some of these, those names for dead, or Boeing, this has been a long time. It's been in this yearly channel. I don't know if it's going to be this year, if it's going to be next year, but at some point, perhaps they unlock some of the money that they have or cash, and Windows 8 does take off, or something goes different for this company, and then it gets to this area. So at this particular point, it hasn't yet, but I do think at some point, if you're a macro investor in Microsoft and you're holding it, you've been holding it for years, I would not sell it in front of this report.
All right, let's do some quick hits here. Silver, just like gold, spiraling lower, dropped 12.6% yesterday following the harsh sell-off in gold. So where is support and how low can this one go?
Well, we talked 22.5 yesterday on support.
Right.
And if you look at the chart here, let's see where it went. It went probably a little bit below it. It went to 21.96, closed at 22.09. Here's where the gap starts. Same thing with gold. It's probably getting some kind of bounce today. This is one of the levels it broke here. This was that symmetrical triangle there. Same case in point, break in macro support. And I would say, maybe it has some room to bounce to about, 23.10. And then if it can get in the gap, that'd be pretty impressive. But, I wouldn't think it would get any more than this. And then at some point, after a little bit of a retracement, I'd say there's a good chance that the silver works its way all the way back down, or this SLV down to a touch below 20, closer to 1950.
And Apple lost 2.3% yesterday, held that key level of 419 that it's held twice before that. So can it continue to hold above it?
We shall see. It's up a few dollars pre-market. I think it was downgraded by two different names. 419 is the level. Other than that, it's been a lot of noise. We have 5 days till earnings, so if they want to discount it one more time, they can. If for some reason, it does rally and get going, this is such a noisy area. 437 is your resistance. It's declining, so I guess since everyone wants to be short this now, maybe it could do something, but I know with the futures up, it's up a little bit. I'm going to look at it. If it could show relative weakness and start breaking below 419, I'm just going to try and catch a little trade there, because it does seem that weak through 419, and you could get a move down to the 400s. And then once we get closer to earnings, we'll figure out whether or not there's a call spread that could be done, which I might do just in case Tim Cook surprises us and actually does something good for shareholders, or I might just avoid and wait for the number and trade it after.
All right, well, Google reports on Thursday the stock has been in an ascending channel, but it failed at the 8-day yesterday. So is this just too risky heading into earnings? Should we avoid it?
I don't think you should take the stock into earnings. If you've been holding Google for 5 years,
right,
and you think that 5 years from now it's got a big horizon, okay, but as far as a trader's concerned, like I usually trade this after earnings, and if they do have a solid report, I think traders will be looking to see if they can get over 800 or even over this little mark here of 815. If it starts getting above there, maybe it has a clear direction to the highs. But again, who knows exactly what the report's going to be like? Who knows how strong the economy is, ad spending? They are digital, they are everywhere, and I think it's going to be okay. If you want to have some kind of risk on, again, going into the report, because sometimes they halt it, sometimes you can't get it, I again would do a call spread. Maybe buy the 800s, sell the 820s. Okay, so if you do get a move above 820, chances are it'll probably cost you somewhere around $5-6 to make, 13-14, which is a decent risk reward. Same way on the downside. If you're playing for a miss, maybe you buy the 770 puts and you sell the 740s, and same thing. So with this one, I would say, you want to finance it, and I know last time or the last few times people have done it, you could do some kind of spread where it costs you $5 to $6 and you have room to 20, so it's like a 2 to 3 to 1 ratio, and I think that's enough of a bang for the buck. And one time, with LinkedIn, it screwed me because LinkedIn went through the roof and I could have made 40 points instead of making 15, but that doesn't happen that often.
Right. Well, yeah, and it mitigates your risk. So Las Vegas Sands slipped more than 4% yesterday and closed at lows. So should we expect more downside today?
This tried to act well, and I actually owned it into yesterday and I got stopped out. You look at the chart here. It is acting better than some other areas, but here I would say is your line in the sand is probably opening up a little bit. If it goes negative, people will use this 53.24 as a pivot, and then you really have bigger support at the 200-day right around here. And if you're looking for momentum, it's got to get above this 56 for that to happen. And
finally, Facebook broke down yesterday as well. What would you say our new point of reference should be?
Facebook. This is like my nemesis. Every good trade gets met with a bad trade. At this point, you look at the chart here, a few things. You still do have this macro, cup and handle pattern, but it's still getting no traction because you never know how long it's going to take before you get something sustained. They are coming out with earnings at some point, so maybe it'll be that. It tried to break this descending channel here, but you want to look at a bigger resistance. It failed right there. So at this point, it's still kind of noisy. I would just take some trades there. If you're in it for the long term, stay in tier 1. I still think there's a nice percentage chance that at some point it takes out the highs of the year. But again, we're in month 4 of the year and we have a lot of time left. So don't let it drive you crazy a little too early.
All right, well, clearly a lot going on today and this week. I mean, we're in the middle of earnings and we're going to get more information today about the Boston Marathon attack. So what will you be focusing on today?
I'm just going to be tactical. I'm coming in today very light, so I'm going to maybe look to short a bounce in some of the weaker sectors. I'm going to see if I can play a bounce to some of those resistance areas that I ironed out, because again, I think the spiders right now are trading 155.50, so there is some room where 155.70 to 156.20, and then maybe even 157.10. So why not try and play a little bit of a rally up to that? Then all of a sudden you see things start to fail, short the bounce, and see if this rally under pressure does turn into some type of real correction that could take us 4 to 7% from the highs, or 5 to 8, or maybe even 10. Who knows? At this point, I'll have levels mapped out to see what type of bounce we have, see how the stocks react to earnings, see what Goldman does today after its decent report, and just take it in stride. I think actually, to be honest, a lot of traders are kind of happy that we pulled off like this, so they don't have to hear all-time highs, historic highs, because there's been a lot of performance anxiety.
Right.
A lot of people did not make as much as everyone of their family members would have thought as they see, oh, we're at all-time highs, sonny boy.
Right.
How you doing?
Ring in the register.
Boom. You saw me on the beach last week, right? And I was in the mountains, and look how that doesn't last too long.
Right. Quickly things change.
Yes.
All right. Well, thanks so much, Scott. Happy trading, everyone. Have a great day.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.